Something fundamental has shifted in the global financial system, and if you're watching this video, you've likely sensed it too. Over the past 18 months, the conversations happening in central bank meetings, treasury departments, and institutional trading floors have taken on a different tone. The questions being asked are no longer about fine-tuning an economic expansion. They're about managing something far more complex. Today, we're going to talk about silver. Not because it's exciting, not because there's a guarantee of profit, but because understanding what's happening with this particular asset right now can teach you something valuable about how major market transitions actually unfold. You're going to hear two completely opposing narratives about silver in the months ahead. One will say it's in a bubble, overheated, and ready to collapse. The other will insist it's still drastically undervalued and heading much higher. Both camps will sound confident. Both will have charts and data. Here's what matters. Which perspective is based on understanding historical patterns, fundamental supply and demand, and the behavior of monetary systems under stress, and which is simply a reaction to recent price movement? If you currently hold silver, you need to understand whether you're sitting on an asset that's reached its peak or one that's only beginning a multi-year revaluation. If you don't hold silver, you need to know whether this is an opportunity you're missing or a speculative mania you should avoid. This isn't about getting rich quickly. It's about understanding a moment in financial history that may not repeat in your lifetime. Let's approach this the way serious investors should, with clear thinking, historical context, and absolutely no illusions. Let's start with what's actually different right now, because most of the confusion comes from people who haven't noticed the foundational shift. For decades, precious metals were treated as relics. Gold and silver were seen as assets for pessimists, doomsday preppers, or people who didn't understand modern finance. That perception wasn't entirely wrong for a specific period. From roughly 1980 to 2000, holding precious metals was genuinely a poor financial decision compared to almost any alternative. But something changed after the 2008 financial crisis, and it accelerated dramatically after 2020. Central banks, which had been net sellers of gold for years, became net buyers, not just modest buyers, but aggressive accumulators at a scale not seen in generations. This wasn't happening because central banks suddenly got nostalgic. It happened because the people managing sovereign wealth began to question the long-term stability of the current monetary arrangement. When China, Russia, India, and dozens of smaller nations simultaneously increase their gold reserves, they're making a statement about where they believe the global financial system is heading. Silver, however, didn't get the same attention. It's smaller, more volatile, and less prestigious than gold, but that's precisely what makes this moment interesting. While gold's price has been steadily climbing and institutions have been accumulating it, silver has remained comparatively flat. For most of the past 4 years, the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has stayed abnormally high by historical standards. Right now, as we speak, that ratio sits somewhere between 80 and 90 to 1. Go back through a century of data, and you'll see that ratio typically reverts to something much lower during periods of monetary stress or inflation. In previous decades, it's dropped to 50 to 1, 40 to 1, even 30 to 1 during certain crisis periods. This creates a mathematical reality that has nothing to do with speculation. If gold continues to hold its value or rises modestly, and if the historical relationship between these two metals reasserts itself even partially, silver doesn't need new buyers or a mania. It just needs to catch up to where gold has already gone. That's the change most people missed. Gold has already had its wake-up moment. Silver is lagging behind in a way that defies both industrial demand fundamentals and monetary history. Now let's address the bubble argument directly, because it's not entirely baseless, and understanding it will help you think more clearly. When silver moved from roughly $18 an ounce to over $30 in a relatively short period, it caught people's attention. That's a significant percentage gain in a compressed time frame. Charts that show steep upward angles always trigger the same psychological response. This must be a bubble. The media narrative follows predictably. Articles appear warning of overheated precious metals markets. Analysts who missed the move suddenly become vocal about why it's gone too far. Social media fills with warnings about a coming crash. This happens every single time an asset makes a meaningful move upward. It happened with gold in 2010 and 2011. It happened with Bitcoin in multiple cycles. It happened with technology stocks in the late 90s. The bubble narrative is the default response to rising prices. But here's what you need to understand. Bubbles are characterized by specific conditions, not just by prices going up. A true bubble involves exponential buying by retail investors who don't understand what they're purchasing. It involves widespread media coverage telling ordinary people they're missing out. It involves easy credit being used to speculate. It involves valuations that have completely detached from any underlying fundamental value or historical precedent. Think about the housing bubble in 2006 and 2007. Mortgage brokers were lending to people with no income verification. Television shows were teaching people how to flip houses. Neighbors were bragging about their real estate portfolios at dinner parties. Everyone believed prices could only go up. Or think about the dot-com bubble in 1999 and 2000. Companies with no revenue were valued in the billions. Retail investors were day trading technology stocks they couldn't explain. The narrative was that the internet changed everything and old valuation methods no longer applied. Now look at silver today. Is your neighbor talking about it? Are mortgage brokers offering silver-backed loans? Are there primetime television shows about silver trading? Is there widespread public belief that silver only goes up? The answer is no. Most people still don't own any precious metals at all. Most financial advisors still recommend zero allocation to physical assets. Most retirement portfolios contain no silver whatsoever. What's actually happening is that a relatively small number of informed investors and some institutional players are recognizing a fundamental mispricing. That's not a bubble. That's the early stage of a repricing, and those are completely different phenomena. The bubble narrative exists because it always exists when prices rise. It's a reflexive response, not an analysis, and it's designed, consciously or not, to keep people on the sidelines until the opportunity has passed. Let's talk about the physical reality of silver, because this is where the story gets genuinely interesting for anyone willing to look at actual data rather than narratives. Silver is unique among major commodities because it sits at the intersection of two completely different demand sources. Roughly half of all silver demand comes from industrial applications. The other half comes from investment and jewelry. On the industrial side, silver is irreplaceable in a growing number of technologies. Solar panels require significant amounts of silver for conductivity. Electric vehicles use substantially more silver than traditional vehicles. 5G infrastructure, medical devices, and electronics manufacturing all depend on silver's unique properties. These aren't speculative future uses. These are current, ongoing, and expanding applications. As the world attempts to transition to renewable energy and electrification, industrial silver demand is structurally increasing. Meanwhile, on the investment side, you have something else happening. After decades of viewing precious metals as obsolete, institutional investors are beginning to consider them as portfolio hedges again. Not in massive size yet, but the shift is occurring. Now here's where it gets crucial. Silver mining is not responding to this increased demand the way markets typically predict. Unlike many commodities, you cannot simply decide to mine more silver when prices rise. Most silver comes as a byproduct of mining other metals, primarily copper, zinc, and lead. Only about 30% of silver production comes from primary silver mines. This means that even if silver prices double, the supply response is limited. You can't just spin up new silver mines the way you might with other commodities. The production is largely tied to the economics of completely different metals. For the past several years, global silver mining production has been essentially flat or slightly declining. At the same time, industrial demand has been steadily increasing. Investment demand has started to return after years of apathy. When you have demand rising and supply unable to respond, there are only two possible outcomes. Either demand must be rationed through higher prices, or industrial users must find substitutes, which often isn't possible given silver's unique properties. The physical deficit in the silver market, the gap between annual production and annual consumption, has been filled by above-ground stockpiles and recycling. But those stockpiles are finite, and recycling cannot scale indefinitely. This isn't speculation. This is arithmetic. You can look at production data from the Silver Institute. You can verify industrial consumption numbers from manufacturing sectors. You can track investment demand through ETF flows and mint sales. The supply and demand fundamentals for silver have tightened significantly over the past 5 years, and that tightening is continuing. This is the opposite of what you see before a bubble bursts. Bubbles burst when supply overwhelms demand, not when fundamental deficits persist. To understand what might happen next, you need to understand how precious metals behave during periods of monetary stress. And we are, without question, in a period of monetary stress. Go back through history and you'll find a consistent pattern. When governments expand their money supply aggressively, when debt levels become unsustainable, when confidence in currency stability weakens, precious metals revalue sharply upward. This happened in the 1970s when the United States left the gold standard and inflation surged. Gold went from $35 an ounce to over $800 in the span of a decade. Silver went from under $2 to $50 at its peak. It happened in the early 2000s after the dot-com crash and aggressive monetary easing. Gold climbed from around $250 to over $1,900 between 2001 and 2011. Silver moved from under $5 to nearly $50. Each time, the pattern was similar. First, a period of monetary expansion and low interest rates. Then, a gradual recognition that inflation and currency debasement were real problems. Then, a repricing of hard assets relative to paper currency. We're currently in the aftermath of the most aggressive monetary expansion in modern history. In response to the 2020 crisis, central banks created more currency in 2 years than in the previous decade combined. Trillions of dollars, euros, yen, and other currencies were conjured into existence. The immediate consequence was asset price inflation. Stocks, real estate, bonds, everything denominated in currency rose. But precious metals, which should theoretically be the most direct beneficiaries of currency debasement, remained relatively subdued, particularly silver. Why? Because the narrative told investors that inflation was transitory, that central banks had everything under control, that modern monetary policy had solved old problems. That narrative is now breaking down. Inflation proved not to be transitory. Central banks raised interest rates dramatically, but debt levels made it impossible to maintain those rates indefinitely. Currency volatility has increased. Trade tensions have escalated. The conditions that historically trigger precious metals repricing are not theoretical future possibilities, they're current realities. Here's what most people misunderstand about these historical patterns. They don't happen because precious metals suddenly become more useful. They happen because currency units become less reliable stores of value and markets reach for alternatives that cannot be printed or digitally created. Silver, despite being more volatile than gold, has consistently participated in these repricing events. And because it's smaller and more thinly traded than gold, its percentage moves have historically been larger. The question isn't whether this pattern will repeat. The pattern always repeats when monetary conditions deteriorate. The question is timing and whether you understand what you're watching unfold. Let's talk about how markets actually move, because this is where disciplined investors separate themselves from everyone else. Price movements in any market are not smooth, logical progressions. They're psychological processes involving fear, greed, doubt, and eventual acceptance. Every major market move follows a predictable emotional cycle. In the beginning, only a small group of informed investors recognize value. Prices start rising, but slowly. The majority ignores it or actively dismisses it. Then comes the period of disbelief. Prices continue rising, but mainstream commentary insists it's temporary, overblown, or irrational. This is where most people make their first major mistake. They watch an opportunity develop, but convince themselves it's already too late or too risky. Next comes the phase of growing awareness. More investors begin paying attention. Media coverage increases. Prices accelerate. This is when the early participants are called lucky rather than smart, and when the bubble accusations begin. Finally, if the fundamental driver is strong enough, comes the euphoric phase. This is when your neighbor starts asking how to buy. This is when media coverage becomes constant. This is when people who bought late start telling everyone they're geniuses. Right now, silver is somewhere between the disbelief phase and the growing awareness phase. It's moved enough to get attention, but not enough to create mainstream enthusiasm. Most people still don't own it. Most financial advisors still aren't recommending it. This is actually the ideal entry point for long-term investors, but it's also the most psychologically difficult time to act. Why? Because you're buying something that has already risen, which feels uncomfortable, but before the majority has validated your decision, which feels risky. Disciplined investors understand that you're supposed to feel uncomfortable when buying assets that others are ignoring or skeptical about. Comfort comes from consensus, and consensus forms at peaks, not in the middle of trends. There's another psychological element at play. Many people who follow precious metals have been waiting years for silver to finally move. They've seen false starts, they've experienced volatility, they've watched the price go nowhere for extended periods. This creates a strange paradox. When silver does start moving, these same long-term observers become skeptical that it's real. They've been disappointed before. They worry they're being fooled again, but market cycles don't care about your previous disappointments. Assets don't owe you anything for your patience. When fundamental conditions align and repricing begins, it happens whether or not previous observers are psychologically ready to believe it. The people who benefit from major market moves are rarely the ones who talked about them the longest or wanted them the most. They're the ones who recognize the transition from preparation to action and position themselves accordingly. If you're waiting for absolute certainty before acting, you'll be waiting until the opportunity has passed. Markets never provide certainty. They provide probabilities that shift as conditions evolve. Right now, the probability that silver is significantly undervalued relative to both its industrial fundamentals and its monetary role is higher than it's been in years. That's not a guarantee. It's a favorable probability worth understanding. If you already own physical silver or silver-related investments, you're probably experiencing a mix of emotions right now. Relief that your position is finally showing gains, anxiety about whether to take profits, uncertainty about whether this move is sustainable. Let me give you a framework for thinking through your situation. First, remember why you bought silver in the first place. If you bought it as insurance against monetary instability, that insurance policy hasn't expired. The monetary instability is, if anything, increasing. The reasons to hold haven't disappeared just because the price has risen. If you bought silver as a long-term value investment based on supply and demand fundamentals, those fundamentals have improved, not deteriorated. Industrial demand is higher. Supply constraints are more pronounced. The undervaluation relative to gold hasn't been corrected. The worst thing you can do right now is sell your position emotionally because you're scared of giving back gains. This is how most investors turn long-term winning positions into mediocre results. They ride the position down patiently, then sell as soon as it becomes profitable, missing the larger move. That said, if your silver position has grown to become an uncomfortably large percentage of your total portfolio, there's nothing wrong with rebalancing. Taking some profits to reduce concentration risk is smart portfolio management, not weakness. A reasonable approach is this. If silver represents more than 15 or 20% of your investable assets, consider trimming enough to get back to a level that lets you sleep at night. Keep the core position, but manage your risk exposure. For those of you who bought silver as a speculation hoping for quick gains, you need to honestly reassess. Have you already achieved a return that satisfies your goals? Are you holding purely out of greed, hoping for more? Are you invested at a size that would be devastating if prices reversed? Speculative positions require clear exit strategies. If you don't have one, you're not speculating, you're gambling. The most important thing for current holders is to avoid emotional decision-making. Don't sell because someone on the internet said it's a bubble. Don't hold because someone else said it's going to the moon. Think for yourself based on your own financial situation and investment thesis. Also, be prepared for volatility. Silver is not a stable asset. It can drop 10 or 15% in a week and then recover. If that kind of price swing would cause you to panic and sell at the bottom, you either own too much or you're not psychologically suited for this asset. The people who do well with precious metals are the ones who understand they're holding a form of wealth that exists outside the traditional financial system. They're not trading it. They're not checking the price every day. They're holding it as part of a diversified approach to preserving purchasing power over time. If that describes you, then recent price increases are interesting but not actionable. Your strategy hasn't changed. Your time horizon hasn't changed. You continue holding and perhaps add on significant dips. Here's the honest answer. You've missed the absolute bottom. If your goal was to buy at the lowest possible price, that moment is past. But that's true virtually every single day in every market. The lowest price is only identifiable in hindsight. The relevant question is whether silver is still significantly undervalued relative to where it's likely to be in the next several years. Based on the factors we've discussed, supply constraints, industrial demand growth, monetary instability, and the historical gold to silver ratio, the answer is probably yes. But let me be extremely clear about something. If you're considering buying silver because you're afraid of missing out, because you've seen the price rise and you feel left behind, that's the wrong reason. Fear of missing out is not an investment thesis. It's an emotional reaction, and emotional reactions lead to poor decisions. You should only consider silver if you understand what you're buying and why. You're not buying a lottery ticket. You're buying a physical commodity with unique industrial properties and a thousands-year history as a store of value. You need to be comfortable with volatility. You need to have a time horizon measured in years, not weeks or months. You need to only invest money that you won't need for other purposes. If you're considering silver, the prudent approach is to start with a small position. Not because silver isn't compelling, but because establishing positions gradually allows you to average your entry price and removes the emotional pressure of trying to time a perfect entry. Dollar cost averaging, buying a fixed dollar amount at regular intervals regardless of price, is particularly appropriate for volatile assets like silver. It ensures you'll buy more ounces when prices are lower and fewer when prices are higher. For most people, a reasonable precious metals allocation within an investment portfolio might be somewhere between 5 and 15% of investable assets. Within that allocation, having both gold and silver makes sense, perhaps weighted more heavily toward gold if you prioritize stability, or more toward silver if you're comfortable with higher volatility in exchange for potentially larger gains. Physical silver, meaning actual coins or bars, comes with storage considerations. You need a secure place to keep it. You need to verify what you're buying is legitimate. You need to understand the premiums you'll pay over spot price. Alternatively, there are silver ETFs and mining stocks which offer easier liquidity and storage, but come with their own risks. Counterparty risk for ETFs and operational risk for mining companies. The key point is this: don't rush. If silver's repricing is genuine and driven by fundamentals rather than speculation, it will unfold over years, not weeks. You have time to educate yourself, start a position thoughtfully, and build it methodically. The people who get hurt are the ones who suddenly decide to go all in after watching prices rise, using money they can't afford to lose, without understanding what they're doing. Don't be that person. Let's talk about the mistakes you need to avoid, because these are where most people destroy their investment returns. First, Do not buy silver with money you need for near-term expenses. This should be obvious, but it bears repeating. If you might need to sell your position in 6 months to pay bills, you should not be buying silver. Volatility will almost certainly force you to sell at an inopportune time. Do not use leverage or margin to buy silver. The temptation to amplify returns with borrowed money is strong, especially when an asset is moving. But leverage turns volatility into account-destroying losses. Silver can easily drop 20 or 30% before resuming an uptrend. Leveraged positions get liquidated in those drawdowns. Do not chase online hype or social media narratives. There are countless forums, YouTube channels, and social media accounts that will tell you silver is about to explode to triple-digit prices. Some of these people genuinely believe it. Others are promoting it for their own benefit. Either way, making investment decisions based on internet enthusiasm is not a strategy. Do not ignore your overall portfolio balance. Even if everything we've discussed about silver is correct, it should still only be one component of a diversified investment approach. If your entire net worth is in silver, you're taking catastrophic risk, regardless of how compelling the fundamentals are. Do not try to day trade or short-term trade precious metals. Unless you're a professional trader with sophisticated tools and risk management, trading volatility is a losing game. You'll get whipsawed by price swings. You'll pay transaction costs. You'll make emotional decisions. The vast majority of people who try to trade precious metals short-term lose money. Do not tell yourself you'll sell if prices drop a certain amount. This is called a stop-loss strategy, and while it has applications in some markets, it's often counterproductive in volatile assets like silver. You'll get shaken out on normal volatility, forced to sell at a loss, and then watch prices recover without you. Do not compare your returns to what you could have made if you'd bought at the absolute bottom. This is a psychological trap that leads to endless regret and poor decision-making. The only comparison that matters is whether your position is likely to generate acceptable risk-adjusted returns from where it is now. Do not assume that because silver has risen, it must fall. Markets don't operate on a principle of reversion to recent prices. They operate on supply, demand, and the value of currency units. Silver can rise significantly from current levels without being in a bubble. Finally, do not neglect your own education. If you're going to hold precious metals, understand monetary history, read about past financial crises, learn how central banking works, understand the difference between currency and money. The more you understand the broader context, the better equipped you'll be to hold through volatility without panicking. Step back for a moment and consider what's really happening in the global financial system, because silver is just one small piece of a much larger transition. For decades, the world has operated on a monetary system based entirely on government decree and debt creation. Money has been whatever governments say it is, backed by nothing except faith in their ability to tax and repay borrowings. The system worked reasonably well when debt levels were manageable, when governments showed fiscal restraint, and when economic growth was strong enough to support increasing obligations. Those conditions no longer exist. Debt to GDP ratios in major economies have reached levels previously seen only during world wars. Governments continue running deficits even during economic expansions. Unfunded liabilities for pensions and healthcare obligations dwarf official debt figures. At the same time, geopolitical tensions have increased. The post-Cold War consensus has fractured. Nations are questioning the dollar's role as the global reserve currency. Trade wars, sanctions, and financial weaponization have made countries seek alternatives to dollar-denominated trade. Central banks responded to recent crises by creating money at unprecedented scales. They claimed this was necessary to prevent economic collapse, and perhaps they were right. But actions have consequences, and the consequence of creating trillions in new currency is that each unit becomes worth less. This is why central banks themselves have been accumulating gold. It's why some nations are discussing commodity-backed trade arrangements. It's why conversations about monetary reform are happening at the highest levels of finance. Silver, because it's monetary metal like gold, but also an industrial commodity, sits at the intersection of these trends. It benefits from monetary instability like gold, but it also benefits from the physical economy's demand for real materials. The reason silver might be significantly underpriced isn't because of a secret conspiracy or market manipulation. It's because most investors are still operating on the assumption that the current monetary system is stable and permanent. When that assumption breaks down fully, not just among fringe investors, but among mainstream institutions and the general public, the repricing of hard assets will accelerate dramatically. We might be at the beginning of that process, or we might still have years before it fully unfolds. No one can predict the timing with certainty. What we can say with confidence is that the conditions that lead to precious metals appreciation are intensifying, not diminishing. The debt isn't getting paid down. The fiscal responsibility isn't returning. The monetary expansion hasn't reversed. Understanding this bigger picture doesn't require you to become a doom and gloom pessimist. It simply requires acknowledging reality and positioning yourself accordingly. Silver is not in a bubble. Bubbles require mass participation, easy credit-fueled speculation, and valuations completely detached from any fundamental anchor. None of those conditions exist today. At the same time, silver is not a guaranteed path to wealth. It's a volatile asset with uncertain timing and potential for significant drawdowns even within a larger uptrend. What silver represents is a problem mispricing driven by a combination of tight physical supply, growing industrial demand, and monetary conditions that historically favor precious metals. The gold to silver ratio suggests silver is undervalued relative to gold. Industrial fundamentals suggest silver is undervalued relative to its utility. Monetary history suggests both gold and silver are undervalued relative to expanded currency supplies. For those who already hold silver, patience and perspective are your greatest assets. Don't let short-term volatility shake you out of a position that may have years left to run. Don't let recent gains tempt you into complacency about diversification. For those considering silver, education and gradual positioning are the path forward. Start small. Learn continuously. Build a position methodically. Never invest more than you can afford to hold through significant volatility. For everyone, the most important skill is emotional control. Markets will do everything possible to make you doubt yourself. Prices will swing wildly. Narratives will shift constantly. Your conviction will be tested. The investors who succeed in environments like this are not the ones with the best predictions. They're the ones who understand historical patterns, position themselves with appropriate risk, and maintain discipline regardless of short-term noise. We are living through a period of monetary transition. These periods don't come along often, perhaps once or twice in a lifetime. They create both significant opportunities and significant risks. Your job is not to predict exactly how events will unfold. Your job is to understand the forces at play, position yourself thoughtfully, and maintain the emotional stability to hold conviction when everyone around you is uncertain. Silver may rise significantly from here. It may consolidate for months or even years before the next leg higher. It may experience stomach-churning volatility along the way. None of that changes the fundamental analysis. None of that changes the supply constraints or industrial demand. None of that changes the historical patterns of how precious metals behave during monetary stress. What matters is that you're informed, you're positioned appropriately for your situation, and you're prepared to maintain perspective regardless of what headlines and price charts tell you tomorrow or next month. The crisis isn't coming. The crisis is already here. It's unfolding in slow motion through debt accumulation, monetary expansion, and gradual loss of confidence in paper assets. Those who recognize it early and position accordingly will likely benefit. Those who wait for mainstream confirmation will likely pay higher prices. Those who ignore it entirely may face unpleasant surprises. But above all, remember this. Investing success comes from understanding, patience, and discipline. Not from predictions, not from hype, and not from following crowds. Stay informed, stay balanced, stay disciplined. That's how you navigate uncertainty. That's how you build lasting wealth.